Hi, I'm Brian Arcese, one of the multi-counselor portfolio managers on the Foord International Fund and Foord Global Equity Fund at Foord's Global Investment Office in Singapore. I'm joined today by Ishreth Hassen, a multi-counselor portfolio manager on our global equity funds, including our Asia ex-Japan fund. With the world braced for another US presidential election, now only 5 weeks away, we thought it timely to look more deeply at the implications of several of the candidates' key economic and geopolitical policy proposals and their potential impact on US and global economies. More importantly, either candidate upon entering office is likely to face an increasingly protectionist world, challenging developed market demographics, widening deficits, and ballooning debt. Though at present, US Vice President Kamala Harris leads former President Trump in national polls, the as of now well-known peculiarities of the US election system render national polling a bit obtuse. In the all-important swing states, polls are within statistical margins of error in all 7. And in the nearly must-win state of Pennsylvania is likely a must-win state for either candidate, polls show a difference of only 0.1%, only a few hundred votes. While we aren't political prognosticators, nor are we likely able to solve the world's woes over the next hour, we hope you come away with a sense of how we've positioned our portfolios to not only weather this uncertainty, but also to take advantage of some of the immense opportunities we see lying ahead. Before diving into some of the most relevant policy differences between the candidates, I'd like to briefly review the current economic backdrop, including our view on the 3 key determinants of market and asset class returns: inflation, interest rates, and earnings. First, on inflation. As we have been stating since last year, it has been our expectation for core disinflationary trends to continue, driven in large part by a respite in shelter inflation. We've highlighted previously the importance of shelter inflation in core CPI, comprising nearly 1/3 of CPI, and the long lag with which shelter inflation moves both higher and lower. As US residential rental contracts are typically signed for 1 year, newly signed contracts will only be fully reflected in year-on-year numbers over the subsequent 12-month period. As a result, newly signed contracts, the new tenant rental index, provide a forward-looking view into where shelter inflation will trend over the next 12 months. This metric turned negative 1.1% in the second quarter. As we move through the fourth quarter and into next year, this will continue to contribute to deflationary pressures on core CPI. Separately, many of you have likely seen that US East and Gulf Coast dock workers had recently walked off the job. Combined, these ports account for 50% of US incoming ocean-going cargo. Thankfully, dock workers have agreed to return to the job until early next year in hopes of agreeing on a contract. While we wouldn't anticipate a near-term uptick in inflationary pressures had this strike continued, any resultant impact would clearly increase should contract negotiations remain at an impasse and as the duration of the port disruption lengthened. For context, prior to this event, the most recent US port strikes impacted US West Coast ports in 2002. These strikes lasted 11 days before then US President George Bush, invoking the Taft-Hartley Act, ended the standoff. East Coast dock workers last walked off the job in 1977, in a strike that then lasted 7 weeks. Well, in the absence of this strike, we would have expected the prices of both durable and non-durable goods to continue their decline and moderation, respectively. We'll be watching these events closely. A lengthy shutdown come January could have a measurable effect on inflation. Other notable inflationary unknowns and wildcards now include rising tensions in the Middle East and the resultant impact on oil prices, and China's recently announced policy changes and their potential impact on stimulating what to now has been relatively tepid domestic demand. Nonetheless, it's our base case that core inflation continues to moderate in the coming months and quarters. Second, on interest rates. Having successfully navigated the first rate cut, Chairman Powell was able to effectively thread the needle with a 50 basis point cut while delivering a balanced message. At the time of cut, the U.S. seemed to be moving toward the so-called Goldilocks scenario, with GDP growth to 3% annualized in the most recent quarter, while inflation further moderated to 2.7% year-on-year. While growth remains robust and inflation has moderated, it is clear that the health and direction of the labor market will take time to fully reveal itself. In the prior two rate-cutting cycles that began with 50 basis point cuts, both 2001 and 2007, the unemployment rates subsequently increased by 2.1% and 5.3% respectively, each time tilting the U.S. economy into recession. Only time will tell if the Fed claimed victory over inflation too early and prematurely pivoted to defending a labor market not yet in need of material support. While we don't put much weight in a single jobs report, last Friday's report was clearly a robust one. The prior 2 months' positive revisions also certainly require mention. If the health of the labor market remains opaque, what is clear is the labor market data between now and year-end will have a meaningful impact on the pace of subsequent rate cuts and an important impact on the direction of risk assets. Policymakers will have one more inflation and one more jobs report before their November meeting, and investors have reduced their expectations for further rate cuts this year from 60 basis points to 50. Nonetheless, the Fed has embarked on what is likely the beginning of a front-loaded easing cycle. And finally, on earnings. As you know, Foord is an earnings house. Held firmly in our philosophy is the belief that over time, a company is worth what it can generate in earnings, particularly in cash earnings. While earnings expectations have been moderating in the US and globally, growth expectations remain relatively robust. Excluding the more rapidly growing information technology and communication services sectors, earnings expectations have declined as we've moved through the year, with year-on-year earnings growth 2024 over 23 of only 3%. Despite these downward revisions, consensus expectations for next year's growth for this same group remain high, with earnings growth estimated to exceed 11%. As we've highlighted previously, leading economic indicators have continued to signal caution, and if anything, would suggest these lofty growth expectations will be difficult to achieve. Auto loan delinquencies have hit levels not seen since late 2010. Housing starts have slowed, and the labor market may be softening. While decelerating inflation and directionally accommodative monetary policy may bode well for equities, high earnings growth expectations coupled with expensive valuations should certainly give investors pause. At 21 times next year's lofty estimates and 19 times excluding information technology and communication services, U.S. markets are nearly 20% above their long-term average valuations. This is not to say that we expect multiples to converge to long-term averages in the near term. However, it is to say that it is our base case that investors will have a better opportunity to deploy their capital in the coming quarters. Where U.S. markets have been expensive, trading at valuation levels in the 90th percentile, Chinese equities have been trading at valuations in the bottom decile relative to their historic range. As many of you know, Chinese equities have comprised upwards of 10% of our multi-asset international fund, double that in our global equity fund, and over 60% in our Asia ex-Japan fund. Over the past week, China's policymakers have responded decisively to mounting economic pressures with a coordinated suite of monetary, fiscal, and regulatory measures. In the wake of the recent Politburo meeting chaired by President Xi, the government's stance has noticeably shifted toward more aggressive policy action. Central to this effort is monetary easing, with the People's Bank of China, PBOC, cutting the reserve requirement ratio, RRR rate, by 50 basis points, injecting over $1 trillion RMB of liquidity into the banking system. Further, policy rates were trimmed, including a 20 basis point reduction in the 7-day reverse repo rate to 1.5%, alongside a 50 basis point cut in mortgage rates for existing borrowers. These initiatives are aimed at easing financial burdens and encouraging borrowing, although it's worth noting that the real issue lies not with liquidity, but with the subdued demand for credit amid a prolonged downturn in the property market. Additionally, in a bid to stabilize equity markets, PBOC has introduced new monetary policy tools. A 500 billion RMB swap program will allow securities, funds, and insurance companies to obtain liquidity from the central bank using assets like bonds and stock ETFs as collateral. The funds, which can only be used for stock investments, aim to boost institutional stock holdings. Additionally, the central bank launched a 300 billion RMB relending facility to help banks provide loans to listed companies and major shareholders for share buybacks. Both initiatives are designed to restore investor confidence and support market stability. Finally, earlier this week, China's National Development and Reform Commission, the NDRC, announced significant fiscal reform, expanding China's fiscal tools alongside the accelerated rollout of key initiatives from the country's 14th five-year plan. Regulatory shifts have also been implemented to tackle the challenges in the property sector, with eased down payment requirements for second home buyers and extended support for developers to manage debt loads. While these measures signal China's awareness of the severity of the economic slowdown and its readiness to intervene, they're unlikely to completely reverse the economic trajectory. Structural challenges, including low household and corporate confidence, as well as fiscal bottlenecks, remain formidable. Still, the policies will likely provide incremental support, helping to stabilize growth and prevent further deterioration, especially in the property sector. Although we're not suggesting that China's economy is now poised for a rapid recovery, these actions represent a clear step towards stabilizing what has become an increasingly fragile economic situation. Our Asia ex-Japan portfolio surged 21% in September, far outperforming the MSCI Asia ex-Japan benchmark's 8.4% gain. Similarly, our global equity portfolio delivered a strong 6.4% return, compared to the MSCI All-Country World benchmark's 2.4%. And finally, our international fund returned 5.8% in September, against a global developed market equity return of 1.8%. Key drivers of this outperformance include holdings in Tencent, JD.com, Alibaba, and Baidu, all benefiting from renewed investor confidence in the region and our non-consensus positioning. Now, turning back to politics, geopolitics, and the US election. As mentioned, we thought we would focus on 4 key economic and geopolitical policy proposals. Those most likely to impact investors: taxes, corporate, partnership, and individual taxes, regulation, particularly pertaining to antitrust legislation, tariffs, trade policy, and energy. I'll walk through the important highlights regarding potential changes in tax and regulatory policy before handing it over to Ishreth to discuss trade, tariffs, and energy. While each of these topics could command their own 60-minute session, I won't attempt to dive into every technical permutation of the potential outcomes, but rather focus on the overarching principles and differences between the two candidates' views of these topics and the resultant potential impact on investors. First, on tax. There are 2 key tax policies with potentially large, differing outcomes depending on who occupies the White House in January, though in part also dependent on which political party controls the US House and Senate. These are the Tax Cuts and Jobs Act, the TCJA, and the Inflation Reduction Act, the IRA. As a reminder, the Tax Cuts and Jobs Act was enacted by President Trump in 2017 and included reductions in corporate, partnership, and individual tax rates. Most notable was the large reduction in the US corporate tax rate from 35% to 21%. Included in the TCJA at that time was the expiration of the act at the end of 2025. Effectively, without an active extension, the TCJA would expire at the end of 25, and US corporate tax rates would revert again to 35%. The resultant adjustment to earnings, though one-off in nature, also meaningfully reduces after-tax cash available for investment and for shareholder return. To be clear, this would be a 66% increase in US corporate tax rates. Looking at the two candidates' positions on the TCJA, in a Trump presidency, investors will likely take comfort in a high degree of certainty that the TCJA will be extended, thus leaving U.S. corporate tax rates unchanged. Importantly, in a Trump presidency, the extension of the act is likely to be achieved regardless of which party controls the U.S. House and Senate. In a Harris victory, however, investors are likely to be confronted with the expiration of large portions of the TCJA, regardless of which party controls the U.S. House and Senate. Though the magnitude of the tax increases may be more modest than the 66% increase I highlighted earlier, it would be a high probability that both corporate and individual tax rates rise. Additionally, if Democrats can shift the composition of the House and Senate in addition to a Harris White House win, tax policy changes could be substantial. Aside from rising corporate tax rates, investors could be confronted with higher capital gains taxes, taxes on carried interest, share buybacks, spin-offs, and executive compensation. As I mentioned, we're not able to walk through every permutation of potential outcome. However, in short, if we limit ourselves exclusively to tax, a Trump win would be viewed as positive for U.S. corporates, while a Harris victory would be viewed as negative, potentially heavily so in a Democratic sweep. The second important piece of tax legislation that is likely to be impacted by the election is the Inflation Reduction Act, IRA, put in place during President Biden's first term in 2022. The act includes provisions to incentivize the reduction of U.S. greenhouse gas emissions by 40% by 2030. The legislation includes generous tax credits for clean energy projects in solar, wind, EVs, and infrastructure. Importantly, the IRA is expected to drive hundreds of billions of dollars of investment in new energy sectors and infrastructure over the next decade. While potential changes to the Inflation Reduction Act are less transparent and more complex than that of the TCJA, they can be no less impactful. While a Harris victory would keep most of the Inflation Reduction Act largely intact, a Trump win with no change in the composition of Congress, which today is Republican-controlled, would likely result in a significant pareback of clean energy tax incentives and deal a moderate blow to U.S. domestic clean energy investments and projects. Now, before turning the floor over to Ishreth, I'd like to touch briefly on regulation. In a divided government, one in which the White House and Congress are controlled by different parties, changes in regulatory enforcement and interpretation are often the only means a president has at his or her disposal. Divided government makes the passage of significant legislation all but impossible. Though changes in regulatory attitudes can impact many areas of government and all economic sectors, I'll focus on two large sectors here: financials and technology. Future capital requirements for large U.S. banks, including JP Morgan, Citigroup, Wells Fargo, will depend meaningfully on who wins the upcoming election. A Harris win may ultimately cement the adoption of Basel III capital rules, requiring banks to boost their Tier 1 capital and increase stress capital buffers, in turn leading to lower returns. A Trump win, however, is likely to lead to further loosening of capital requirements, at least over his term in office. This outcome could further boost bank returns and ultimately bank shares. Ironically, President Trump appears more aligned with current President Biden on the issue of technology platform regulation. Though it isn't clear the former president's disgust with large-cap tech is antitrust-driven, a Trump win would likely result in little change to the current administration's policy of working to limit the dominance, market share, and power of large technology platforms. A Harris win, on the other hand, though not a complete respite for large-cap technology firms, is expected to result in a more balanced approach, with some analysts foretelling the settlement of certain cases viewed as relatively weak, in particular against Apple and Amazon. Now I'll pass the floor to Ishreth Hassen to walk through the candidates' positions on the additional topics of trade, tariffs, geopolitics, and energy, and the possible resultant impact on markets.
Thank you, Brian. The US election is obviously a hot topic these days, and you can probably read about most key policy differences in the media. So what I'd like to focus on instead is to zoom out a bit and provide some context and a framework for how we think about some of the larger forces at play, particularly around areas like trade and tariffs, energy policy, the electrification of the world, and increasing protectionism in a new multipolar world order. These are, of course, big themes in the upcoming election as well, but more importantly, will likely continue to play a major role in driving investment decisions and portfolio construction for years to come. So let's start with trade. As you may know, the Biden administration has already proposed a 100% tariff on Chinese electric vehicles, while also heavily restricting advanced semiconductor exports into China. Donald Trump has spoken of an additional 60% tariff on all Chinese goods and a 10% tariff across the board on all imports. So what's the likely path forward? Is there an impetus for a more benevolent stance, regardless of who sits at the White House, at least pertaining to China? The answer is quite layered. So we need to first understand why the US is on this protectionist path to begin with. If you look at the last 2 decades, China has industrialized at a rapid pace to become the factory of the world. There are many factors that make them perfectly suited for this job, including a cheap and educated workforce, a central command economy which made scaling very easy, and a vast captive market and population. There are, of course, other forces, but these are the big ones. Now, fast forward to today, and China is now the world's largest producer of most clean energy products, including electric vehicles, batteries, power inverters, solar cells, wind turbines, etc. So if you believe that the energy of the future will mostly be manufactured, like say solar, wind, or nuclear, versus being drilled or mined as in the past with oil and gas, then China is positioned to remain the world's largest manufacturer and exporter of clean energy products at a global level for a while to come. So maybe the US and perhaps the rest of the West feel threatened by this. They attribute China's success to government subsidies and now want to level the playing field with tariffs and restrictions. But what we need to understand is that China's subsidies are no different to various subsidy programs offered elsewhere to support local industry and the development of certain market segments. It depends on what a country is focused on promoting and where they choose to direct their fiscal spend. For example, the CHIPS Act in the United States amounts to around $280 billion in subsidies to boost the domestic semiconductor industry. Also, the EU has been subsidizing green energy at a similar scale to China for the past 2 decades. What's also important is that China's subsidies for green technology have been available to anyone and everyone, not just Chinese companies. Elon Musk, being the visionary that he is, was very early to capitalize on the same subsidies that were available to BYD or CATL, which are China's largest EV and battery tech companies. This is why Tesla spent $2 billion on their massive Shanghai gigafactory, which was heavily subsidized by the Chinese government in the form of free land, cheap loans, and tax breaks. Now, the rest of the global auto industry were unfortunately asleep at the wheel, no pun intended. So you can't really turn around now and blame the Chinese government simply because you can't compete. Tesla is one of the most aggressive automakers on pricing, even in China, and they're doing just fine. But will this direction of protectionism change longer term, regardless of who sits at the White House? I doubt it, at least not within the United States. China is an easy bipartisan villain that both Republicans and Democrats can get behind for destroying their uncompetitive industries. US and European automakers could have easily won the EV race if they had executed and had foresight like Tesla had. Even today, after these 100% tariffs were announced, GM, Ford, and Fiat Chrysler, or Stellantis as they're now called, so the big three legacy automakers, all announced plans to cut back R&D spend on EVs and ramp up their share buyback programs instead. This is exactly what Boeing did in the years preceding their recent failures with the 737 MAX. Instead of investing in a new platform, they cut costs and ramped up the repurchase of their own shares to juice EPS and hit management incentive targets. So tariffs are not a great long-term solution in our view. It makes your domestic industry complacent and uncompetitive on a global scale over time. Then we need to ask if tariffs at least weaken China and their dominance of these industries by closing off domestic markets, be it in semiconductors or electric vehicles. I think what's important to understand is that China has a massive captive domestic market for their industries that's becoming bigger as their population becomes more affluent. Their innovation began years ago with things like solar, wind, batteries, and EVs, but they're now making breakthroughs in areas like aerospace, defense, nuclear technology, and semiconductors as well, all out of necessity to be self-sufficient because of these very restrictions that are now being imposed on them. So let's take electric vehicles, which gets all the headlines these days, but you can pretty much apply this framework across most technologies that China chooses to focus on and scale. Even with just their domestic market, China has already built massive scale to be the lowest cost producer globally by far, by a magnitude of around 2 times, which is exactly why the US is taxing them by 100%. Today, China produces more than 60% of all electric vehicles worldwide, while the US and Europe together accounted for just a third of production. And it's the same story with infrastructure. China has more than 85% of the world's fast chargers. And for example, in Shenzhen, there are now more supercharging stations than gas stations. So nobody can do this better or cheaper than China can at this point. But despite the scale already, China still has a big unmet need given their population size. This penetration chart on the right is a bit dated, but the message remains the same today. Only 4.5 out of 1,000 people in China own electric vehicles, compared to around 7 in the US and more than 12 in Europe. So the runway remains very significant. Beijing has chosen to promote electric vehicles in the country, not just for environmental reasons, but because of their vital energy security. China's foreign oil dependency ratio is more than 70%, which is far too risky for an economy of its size that's centrally managed. So electrification is part of an intentional national strategy to replace oil and gas with renewable electricity over the long term. Europe and India are similar to China in that they are also net importers of oil and gas, and it's the opposite in the US, where they've now become a net exporter with their newfound shale riches. Either way, given this domestic scale, China has almost single-handedly made the green energy transition cheaper for the entire planet, as we can see from this chart of wind turbine prices. The trend is similar across most other green energy products as well. So as far as China is concerned, they are all in on renewable energy and electric vehicles going forward. They will dominate the industry globally, whether they're allowed to sell into the US and Europe or not. EVs have already surpassed internal combustion engines in new car sales in China, with local brands now taking more than 70% market share. So the US can ban Chinese brands from entering, but can the Europeans do the same? Their own automakers and industrial businesses rely very heavily on China for their earnings, in some cases for more than a third of their profits. At the same time, Europe has chosen to dogmatically move away from hydrocarbons and Russian gas, which has dramatically increased their energy costs and made them very uncompetitive at a global level, as can be seen from this chart. So Europe is in a real bind with a catch-22 as far as trade with China is concerned. China is both the problem and solution for them. But what about the rest of the world? In the past year, Russia, Mexico, and Brazil have become the top 3 export destinations for Chinese electric vehicles. China's top-selling EV brand BYD is expanding globally at a rapid scale. And they're building plants in Hungary, Thailand, Brazil, and Turkey, to name a few. In Thailand, for example, they already have 40% share of electric vehicles and just opened a $1 billion plant to produce 150,000 vehicles annually. The other thing to keep in mind is that the leading Chinese EV makers remain profitable despite some tariffs, at least in Europe. Even with a 30% tariff in Europe, BYD could still achieve around a 10 to 15% profit margin, equivalent to around $4,000 to $5,000 per vehicle on a $50,000 car. What's surprising is that this profit per unit sold in China is probably 1/3 of this. Not only that, BYD is also localizing production in Hungary and Turkey, which are part of the EU, so can supply Europe with lower tax cars from there instead of importing them all the way from China. Ultimately, Chinese companies are just naturally accustomed to competing at another level versus their Western peers. They're battle-tested and forged in the fire of the toughest market on the planet, which is their own home market. So all other automakers will obviously lose share over time. Over the past 5 years, German market share in China has dropped from more than 20% to less than 15%. BYD has now beaten Volkswagen to become China's top-selling brand, with VW's volumes halving since 2017, while BYD's volumes have increased by more than 10 times globally. So while tariffs and trade restrictions may help reduce deficits or slow down China in the very immediate to short term, ultimately what it achieves is accelerate China's need for self-sufficiency, as we're seeing with Huawei and their semiconductor industry. It will also drive China to expand even more aggressively in international markets to entrench their leadership position globally. So tariffs are just a band-aid to stop a gushing wound. Over time, they will likely prove ineffective and just set the stage for an accelerated global decline of US and European brands. But for now, they can remain complacent for a little while longer. But then we must ask if either candidate can galvanize the rest of the world in their bid to curtail China's advance. This too is a complicated issue, but let's try provide some context around it. If we go back just 200 years prior to European colonization, India and China's share of global GDP was around 25% each. After colonization, this fell to less than 5% each, given the massive exploitation that took place. By 1914, Europe, with only 8% of the global population, controlled almost 90% of the world's landmass. So these injustices are still felt quite strongly across the non-Western world today. And there's a movement now to return to a more equitable, multipolar world order, more consistent with this broader span of history. There was this interesting study conducted by the University of Cambridge after Russia's invasion of Ukraine that shows a big shift in non-Western attitudes towards China. So in this study, among the 1.2 billion people from Western developed nations, 75% now hold a negative view of China and 87% a negative view of Russia. But for the 6.3 billion people who live in the rest of the world, the picture was very different. In these societies, 62% felt positively towards China versus 61% for the US, which is the first time ever that China is now seen as more popular than the US. What was more surprising is that Russia's popularity was greater than both the US and China at 64%, driven by Southeast Asia and most of Africa, despite recent events. And this is across 85% of the world's population, which is very telling. So if you boil it down to the numbers, the population numbers, the US and Western Europe represent just 13% of the world's population, while China and Russia together represent around 20%. That leaves 2/3 of the global population that's not aligned one way or another. So if you take India for an example, which is 18% of the world, even though they're not particularly close to China and are seen as a big beneficiary of Western production moving away from China, India is very close to Russia. India's oil imports from Russia have increased from 0.2% in 2021 to now more than 20%. Russia is also India's biggest arm dealer, supplying them with around half of their weapons imports. So what does all this mean? In my mind, regardless of who is voted into power, it will become increasingly difficult for the West to dictate terms beyond their home markets, particularly concerning growing powers like India, China, and Russia. It's already difficult with the Biden administration, as we can see with India and Russia, but it'll be more so in the case of a Trump victory. Last time around, Trump made a very poor impression on the rest of the world with his America First policies by pulling out of the Paris Accords for climate change and the Trans-Pacific Partnership with Asia, which left a bitter taste in the mouths of everyone involved. What's increasingly clear is that there's a much larger structural trend already underway towards a multipolar world order instead of the prevailing unipolar one. And that brings us to energy policy, which of course always involves lots of geopolitics. What does a Trump or Harris White House mean for energy markets, both for oil and gas and green energy? Again, there are several drivers at play here. We can probably expect a continuation of Biden's energy policies under Harris. But will Trump be pro-drilling and anti-environment as he was the last time around? Will he cut Russia slack and allow them to decisively win the war in Ukraine, which means Russian energy possibly comes back to Europe? Both of which could have very negative consequences for oil prices over the short to medium term. But regardless of who wins, there are some larger immutable forces at play. Since Ukraine, Europe has been trying to shift their dependence on Russian energy to alternate sources. OPEC's position has been to cut oil production by 2 million barrels a day into this tightness to maintain pressure and keep prices high. So this is in relation to a total market size of around 100 million barrels a day. But if you zoom out further, total petroleum output globally over the past 2 decades has been mainly driven by the US shale oil and Canadian tar sands, which added almost 10% or 10 million barrels a day to global oil supply. Without North America, global oil output would have fallen by around 5% over the past decade. And looking forward into the next decade, all other non-OPEC producers are expected to lose around 20 million barrels a day without new discoveries or further exploration. At the same time, this incremental US output is now starting to flatten out. But if Trump wins and the US becomes pro-drilling, that could definitely change the oil market dynamics, which would be great for oil service companies over the next 3 to 5 years. With Harris, you probably have more of the same, with subsidies for renewables through initiatives such as the Inflation Reduction Act, which ironically contributes to structurally higher energy prices by duplicating globally established supply chains in the US. Then there are the geopolitical implications of an accelerated shift to green energy. As we've outlined over the years, China controls the entire value chain for renewable raw material and is the lowest cost producer by far. Most of these materials are supply constrained, which will become worse over time. Demand for battery materials alone is expected to grow by more than 10 times over the next decade. Existing mines are being depleted, and it's a lot more difficult to bring new mines into profitable production. So regardless of how the energy mix evolves, geopolitics will continue to play a major role going forward. Resource nationalism is a trend that has only accelerated, with self-sufficiency and security being prioritized by resource-rich states. Indonesia, for example, has said that they are exploring an OPEC-like cartel for nickel, which is critical for EV batteries. Ultimately, everyone will require China's materials expertise to decisively move towards a cleaner, greener world. With all these vulnerabilities and security considerations, the West has sought to duplicate supply chains, which is inherently inefficient and can continue to drive an increasingly inflationary reality going forward. So we could be in for a very interesting decade going forward, depending on the outcome of these elections. Finally, what does this mean for climate change longer term? We know Trump is not a believer, having withdrawn from the Paris Agreement in 2017, which was a big disappointment on the international stage. Biden later rejoined the group in 2021. I think in order to have a complete picture on which countries have contributed most to climate change, it's important to distinguish between the flow and stock of greenhouse gases. It's true that developing countries like India and China have, in the past few decades, contributed more flow of greenhouse gases, but most of the existing stock of gases was contributed by Western industrialized countries since the beginning of the Industrial Revolution. Also, most of the recent flow generated from the likes of India and China has been to produce cheap goods for their Western customers. If you look at this chart of CO2 stocks since the 18th century, the US has emitted nearly 420 billion tons of CO2, more than any other country to date, and representing more than 25% of total historic emissions. Europe comes in at around 290 billion tons, while China has contributed little more than half of total US emissions. On a per capita basis, China is much lower given the differences in population size. So it'll be very difficult for the US to be pro-oil and anti-environment while expecting other polluting countries like China or India to cut emissions to stem global warming. But then what about other parts of the world? Clearly, the world is not just the US, China, Europe, India, and Russia, right? How do the rest play into this new world order? As I alluded to before, there's around 3 to 3.5 billion people outside of these big countries. For example, the combined GDP of ASEAN is more than $3.5 trillion, making it the 5th largest economy in the world. And by 2027, they'll likely be the 4th largest because they're just growing much faster than the rest of the world. With a population of around 650 million people and 2.5 times the size of Western Europe, ASEAN is also a region rich in commodities and energy. But even if ASEAN would like to remain neutral, ultimately they are economic pragmatists. Since the year 2000, China-ASEAN trade has increased by 22 times, reaching close to $1 trillion this year. In contrast, US-ASEAN trade has grown just 3 times to around $440 billion. So China is more than double the size and growing faster in terms of trade flow, and this is only natural given their geographic proximity to the region. US policy in ASEAN has not helped either. When Trump pulled out of the Trans-Pacific Partnership in 2017, ASEAN became very skeptical of Washington's long-term commitment to the region. China, in contrast, went all out with their vaccine diplomacy during COVID and is rapidly expanding infrastructure projects and investments across the region. China's approach to international relations of mutual respect and mutual benefit, as well as non-interference in a country's internal affairs, seem to resonate better in ASEAN, as we've seen firsthand in the case of Singapore as well. So ASEAN is just one example, but you probably see similar dynamics in other big regions around the world, like South America, Africa, and the Middle East as well. So yeah, that's it from me. With that, I guess we can move to Q&A with Brian.
Thanks, Ishreth. Thank you. Thank you for submitting questions during the sign-up portion of the webinar, and thank you for submitting questions live today as well. We've incorporated as many of the questions submitted earlier into the webinar itself, and anything that we can't get to or didn't get to then or can't get to during the Q&A, we'll certainly be sure to get back to you. Now, Ishreth, you spoke a lot about kind of some of these big geopolitical shifts. And I'm just curious, what impact do these big geopolitical shifts have on how you think about your investment framework, how you think about portfolio construction, and how you think about stock selection broadly?
Sure. Well, I mean, if you look at what characterized this multipolar, or rather the unipolar world order over the last 2 decades, right? You had free trade, globalization, supply chains that were built for efficiency rather than resiliency, a relatively peaceful world, and stable or reliable energy supply. Now, all these factors together had quite a disinflationary impact on the world. And going forward, I'm not sure that would be the case, right? Because each of these factors are now moving in the opposite direction, and that could be highly inflationary. So, for example, supply chains that are being localized and built for resiliency rather than efficiency. Previously, you could buy a US multinational company that was expanding globally and rely quite comfortably on sustained earnings growth and multiple expansion as these big businesses became even bigger as they just carpeted the whole world. But I'm not so sure that you can rely on the same forces going forward. Stock picking would have to be a lot more discerning. You'd have to think through these forces of population size, the consumer, supply chain, and energy supply quite deeply to sort of understand where growth and earnings can go longer term. So yeah, definitely will be quite a different environment from the past 2 decades. And that's very good for people who focus on picking stocks and thinking through the core drivers of earnings, you know?
Yeah. We obviously have a couple of questions on China, which we've been chatting about for quite a long time, but it is also very topical. In particular, questions around kind of the monetary and fiscal support that's been kind of implemented over the past 7 to 10 days. Our expectations of its impact, and what are we really looking for to measure that impact? And then also around our own portfolio positioning. So maybe I'll chat through the first one and you can take the one on positioning.
Sure.
I mean, if we look at what has been announced and is in the process of being implemented, we kind of divide it into 3 buckets, I suppose. One, on the monetary side, so increasing liquidity for banks, for example, lowering interest rates. We have the fiscal stimulus that has also been announced, and then we have a pocket of basically the first time this has been used so explicitly, but opening a facility where banks can post collateral and use specifically to invest in equities, for example. If we look at those 3 buckets, at least in my mind, liquidity hasn't necessarily been the issue in China, right? Banks, particularly state-owned banks, have been well capitalized, even though they've been providing lending support. The consumer is certainly well capitalized. So I think while that is helpful to the economy, it's probably not the piece of the 3 that will be most meaningful. The other 2, certainly, I mean, providing fiscal support for specific projects and putting money directly into the economy and even directly into consumers' pockets in some ways can certainly be quite stimulative. But as we've chatted about, what the government has really needed to do is boost demand and improve sentiment. And I think fiscal stimulus gets to that obviously more than a monetary side. And then finally, providing the facility where financial services firms can post collateral and boost their equity holdings has certainly, over the period we've seen, increased demand for Chinese equities, both onshore and offshore. That, in and of itself, may also improve sentiment, right? Which will then lead to kind of more demand. So it all can feed on itself. All of them individually are meaningful, but together, obviously, they're much more meaningful when combined. And I think that the second part of that question is, how do we know if they're working, is obviously the most important part. I mean, clearly markets have run ahead of the evidence that the policies are actually working yet. I think that will come down to, right, we're fundamental investors, and it comes down to looking at the underlying fundamental economic data. If we see improvements in the property market, which there are green shoots of, if we see improvement in sentiment, and we see consumer demand pick up, then those obviously would be clear signs that these policies are working. But I think it just takes time for them to feed into the underlying economy.
Yep.
But maybe I'll toss it to you to talk about how we're positioned.
Sure. I think as you rightly pointed out, things will be path dependent. But I think what's key is also the starting point, right? You've had this vigorous rally, but the base was so depressed and companies were so cheap, which is why we had so much of them to begin with. The valuations were, I would say, absolutely ridiculous, from 2 weeks ago. They're not as ridiculous today. They were 3 to 4 times free cash flow for businesses that in similar markets outside of China would be worth at least 15 to 20 times. And now they've re-rated maybe 30-40% to maybe 6 to 8 times free cash flow. They're still extremely cheap, and these are off very depressed base of earnings and base of free cash flow. So, if these measures really do have an impact on reviving the large economy and consumer confidence and spend, what you'd see is a very meaningful acceleration in not just top line, but definitely in earnings as well. And then the multiples can re-rate substantially higher. I think, even if you look at the stocks today, they're only back to where they were in January of last year, despite, how vigorous this rally has been, which tells you how depressed the base was and how long it's been depressed for as well, right? Obviously, we've been seeing this value for quite a while. It's gotten even more value in recent months. But in my mind, even just a sentiment uplift alone should be able to lift valuations substantially higher, because these stocks are still priced at far less than what they're truly worth, even in a depressed scenario where the economy doesn't improve dramatically, but just bumbles along, I think we'll see what happens with the economy and consumer spend. But I think we're quite optimistic that the stocks can re-rate quite a bit further going forward.
Yeah, and I think to your point, it really is all about the fundamentals, and I think that starting point. Some of these equities were so undervalued that we have received questions around, well, given the significant re-rating over a period of 5 or 6 days, does it now make sense to trim? But when you fall back on the fundamentals, they're more expensive than they were a week ago, perhaps, but still quite attractive relative to the rest of the opportunity set that you look at, globally.
Sure. No, that's the thing, right? These are still on 6-7 times free cash flow. The rest of the world's at 20, 30. Apple's on 30 times earnings. Microsoft's on 30 times earnings. So, are those good value for investors? We do own some of them just because they're such a big part of the index. But so it's a question of relative value and where we have a variant perception on understanding the earnings that these businesses will generate, not this year, but like 2-3 years down the line, you know. So, I mean, there's no, as we've outlined previously, we're not really dogmatic or emotional about these businesses. Ultimately, it all boils down to value and our conviction in what these businesses are worth and how soon they can potentially get there, right? So we'll change if the facts change, and if these policies don't end up making a sustainable impact, then we're always happy to reallocate that capital elsewhere if we can find better value where we have better variant perception. Yeah, so we'll assess it on a day-to-day basis. We may trim certain stocks where the value is realized, whereas others where there's a lot more room to run, we'll maintain those positions.
We have also a broad question about kind of asset allocation and how the portfolios are positioned in general. Maybe again, I'll start and then obviously you can hop in and add as well. But from an asset allocation standpoint, in particular talking about the international fund, obviously, just to give a broad sense, a very high level of where we are, we're about 70% on a gross basis invested in equities, slightly higher than that. We do have a hedge position on equities, so it brings our net equity position in the multi-asset fund to around 66-67%, right? So about 2/3 of the portfolio on a net basis is invested in equities. At the moment, about 12 to 13% is invested in fixed income, which is a combination of sovereign and corporate credit, primarily US sovereign credit. And then we still have a 5.5 to 6% position in gold. So we've chatted a lot about inflation today, about interest rates. I mean, we've held gold in the portfolio for quite some time. We've also chatted about geopolitical risk. Gold really isn't in there as a hedge against inflation. It's not a great hedge against inflation, but it has historically been quite a good hedge against volatility and geopolitical risk, right? And has benefited the portfolio over the years because of that. So we still have that position. And really the balance is held in cash. So the cash in the portfolio is about 4 to 5% in real cash, right? And then adding on to that, the additional cash created through the hedging results in about 15% of the portfolio or so being invested in equity. So it's quite balanced at the moment, but within that, I think it's also important to chat to how we are positioned both by region and sector. And that really is similarly across the multi-asset portfolio and global equity. So in general, we have investments that are certainly tilted towards the consumer, right? And in particular, the Chinese consumer. So as I mentioned during the webinar itself, about 10% of FIT sort of is invested in China, obviously about double that for global equity and considerably more for Asia ex-Japan. But a lot of that exposure relates to the Chinese consumer. It's obviously where we see the most value and high quality companies. The areas of the market, and obviously that China overweight needs to be funded from somewhere, right? And we have been and still are underweight largely the US, funding it from there, and the consumer overweight really funded in an underweight to financials, for example, and to a lesser extent an underweight towards information technology. So traditional IT, as you know better than I do, has a lot of hardware, for example, and semiconductors, whereas we're invested more in comm services, the Tencents, the Googles, the Microsofts. So broadly, I mean, that's how we're positioned. I know it's quite brief, but by asset class, and then also by sector and region. Perhaps, I mean, you can add on a bit to that.
Yeah. I mean, what I'd say is that broadly, we'll allocate to where we see value, right, for our investors, where we feel the gaps between the business's worth and what it's priced at today are the greatest. So that's precisely why we've had such a big overweight to China already. Now you're starting to see that gap close. And as that happens, we'll reassess the global opportunity set in real time, you know. So I mean, The reason we haven't been in tech hardware just because, I mean, that sector has been driven by all this hype around AI, and some of these valuations are ridiculous. And it's happened a lot quicker than the earnings would suggest on these businesses. They've re-rated to multi-year highs in terms of valuations. I mean, NVIDIA, for example. But I mean, broadly speaking, I think we are happy to reallocate to the US if there's a meaningful correction, because I mean, if you look at what's driven the US market, right, it's been such a narrowly driven rally, and usually these happen when the market is reaching toppy levels, which you can evidence would suggest it, or at least on valuation, it's also there. But now rates are coming down. I mean, we do have stocks and businesses that would work in that case as well. So it's not, I mean, we're not 0-1 either way. And as value shifts, we would definitely shift our allocations as well. I mean, the way China's moving, if it moves the next 2 weeks the way it has the last 2 weeks, then we could have quite a different portfolio allocation in a month, you know. Yeah. So that's what I'd say. Yeah, we just go to where the value is globally, and not value in like cheap PE stocks, right? Like true value. I mean, it could be a growth business at 50 times earnings. If it's going to grow earnings 100% over the next 5 years, that'll shrink that multiple quite dramatically. And so it's recognizing that ability to grow earnings is what we do as a team by a sort of sector-centric, deep research done by the analysts, like on the specific underlying sectors, you know?
Yeah. No, that's great. Thanks, Ishreth. And thank you for joining us today on our discussion of market-driving forces, including inflation, interest rates, and earnings, and the important fundamentals moving through the year-end into 2025, including tax, regulation, trade, tariffs, geopolitics, and energy. While we won't correctly call each of these outcomes, the important takeaway is to construct portfolios to be what we call all-weather. Portfolios that are not designed to only perform if our base case comes to fruition, but rather to perform well regardless of economic backdrop or regulatory outcome. This is how we've always constructed portfolios at Foord, and how we'll continue to do so going forward. This concludes our webinar, and we would appreciate your feedback on how we can improve them in the future. To that end, a short survey will open automatically when you end the session. Thank you.